Welcome to the debate. Um, Imagine taking a perfectly tuned algorithmic trading bot, a system that flawlessly executes trades in milliseconds based on just hard math.
Right, a purely quantitative engine.
Exactly. And then forcing it to pause, look at a picture of a chart, and write a diary entry about how the market sort of feels today.
Yeah, it's a completely radical pivot. I mean, you have a system that was built entirely for speed and precision, and suddenly it's being re-engineered to act like a qualitative observer.
It is. And that is exactly the paradigm shift we are unpacking today. We're looking at the May 14, 2026 session export that details the Eastmont SDK and its entirely new visual memory evolution.
Which is quite the document.
Oh, it's massive. And the central question we're exploring is whether this transition, moving the Eastmont SDK from a standalone set of automated trading bots into this unified AI-driven behavioral market memory system, is a necessary evolution for true market intelligence.
Or, conversely, if it's just a massive overcomplication. Because the alternative view is that this abandons the reliable, objective precision of technical execution.
Right. And I take the position that evolving into a behavioral analysis engine, specifically one equipped with visual memory and these journal-linked frameworks, is a non-negotiable leap forward for market reasoning.
And I take the opposing view. Because, look, while the ambition of creating a synthesized qualitative AI market observer is, it's intellectually fascinating as a computer science experiment, but replacing precise, hard data tools like the execution bot or the DipFire X bot with subjective AI visual ingestion and automated journaling, it just introduces a really dangerous level of ambiguity.
I don't think it's ambiguous, but
I mean, in financial markets, the margin for error is razor thin. Mathematical precision is your only true anchor, and this evolution really risks cutting that anchor entirely.
well, let's ground this in what the source text calls the massive realization, because the developers of the Eastmont SDK, they looked at their architecture and realized they had kind of hit a ceiling.
Right.
The old priority was essentially just building more Telegram commands to trigger basic alerts. But they realized the system already possessed significantly more latent intelligence than a simple ticker analyzer actually requires.
Sure.
I mean, they had a technical engine, they had an RSI, relative strength index engine, a reload zone engine for finding dips.
Which I have to point out are all incredibly effective, purely quantitative tools.
They are, but they're isolated tools. By activating layers like trend state analytics, time of day analytics, and journal intelligence, they realized the SDK could synthesize these complex overlapping market dynamics.
Yeah, but synthesis at what cost?
Well, it's about moving away from disconnected alerts. Like, if a ticker hits an RSI of 30, that alone is just a raw data point. But if the system can actually remember how that specific ticker behaved over the last year when hitting that RSI level, specifically at, say, 10:30 a.m.,
Okay, but
and cross-reference that with qualitative journal observations, you are no longer just scanning the market. You're building a true market co-pilot. You're building a system that reasons about price action rather than just blindly reacting to it.
That sounds incredibly sophisticated on paper. Truly, it does. But we have to aggressively defend the efficacy of the current body ecosystem as it stands, because look at what they're threatening to move away from.
They aren't moving away from it, though.
Well, they are deprioritizing it. You have the DipFire X bot, which handles intraday dip intelligence and reload zone detection with absolute mathematical certainty.
Yes.
You have the Intraday Pattern Bot, which objectively monitors for bull flags and breakouts. And crucially, you have the Validator Bot for signal scoring and false positive reduction.
Right. The Validator Bot is key.
Exactly. And these rely on strict objective parameters. A bull flag is a specific geometric and volume-based reality.
But those geometric realities fail all the time if the broader context is wrong. I mean, you know this.
They fail based on probability, which can be measured. The priority shift outlined in this document, moving toward screenshot intelligence and Obsidian integration, it fundamentally dilutes that strict mathematical reality.
I have to disagree.
You're taking a system that processes clean data feeds and trying to synthesize it with something as wildly subjective as an AI journal observation. You risk moving the entire SDK from statistical probability into the realm of AI hallucination.
That's a huge leap.
To use an analogy, it's like you're taking a fiber optic cable meant for high-frequency data and capping it with a human translator who has to, read the data out loud.
Okay, I think you're mischaracterizing how the architecture actually functions, because the text specifically positions the SDK as the orchestration layer.
Orchestration layer, sure.
It is not that the technical precision of the DipFire X or the Validator Bot is being deleted or discarded. That's a misconception. The Eastmont SDK is being elevated to act as the memory system and the query layer that coordinates those standalone bots.
But how does it coordinate them without diluting them?
Think of it like a human portfolio manager at a hedge fund. The manager doesn't just read raw ticker feeds and blindly execute when a 50-day moving average crosses. The execution desk does that.
Right.
The portfolio manager synthesizes the market context. They look at the technicals, absolutely, but they rely on their historical memory of the asset's behavior to make a nuanced decision on whether to deploy capital on that specific moving average crossover today.
Okay, but mechanically, how do you actually code that synthesis?
Through the query layer.
Let's talk about the Validator Bot, because its entire purpose is false positive reduction. It processes an API JSON payload. It expects a number, it expects a probability score, say 0.85, to say, yes, this setup meets the statistical threshold for execution.
Right, that's the baseline.
So if the orchestration layer is pulling in an AI diary entry that says, Mara is acting choppy today and feels top-heavy, how does the Validator Bot process that unstructured text?
Well,
What is the mathematical weight of a qualitative journal entry? By modeling a pristine numeric input with an AI's qualitative reasoning, you are completely eroding the mechanism of false positive reduction. You cannot mathematically validate a narrative.
You don't mathematically validate the narrative. The narrative contextualizes the math.
I'm not sure I see the difference when it comes to capital allocation.
The difference is that the orchestration layer is designed to answer advanced queries. Commands like, what changed AMD or profile SoFi. When a user asks what changed, they aren't asking for a JSON payload. They are asking for synthesis.
They might be asking for performance metrics.
But this brings us to one of the most fascinating breakthroughs mentioned in the export, the concept of ticker personality. The system is evolving to understand that different assets behave differently under identical mathematical conditions.
And this is where the logic really falls apart for me.
Just hear me out on the examples the text provides. The SDK is being trained to understand how SoFi commonly reloads, where TSLL, the leveraged Tesla ETF, where that often fails.
Yeah.
It's learning how Mara behaves during volatility spikes and where NVDA historically bounces. A purely quantitative bot treats every asset crossing a 50-day moving average exactly the same.
Because math is universal.
But the SDK recognizes that which moving averages specific tickers respect most is a variable, not a constant.
Let me stop you right there, because I'm sorry, but I just don't buy that. The entire concept of anthropomorphizing financial assets is a cognitive trap.
It's not anthropomorphizing.
It absolutely is. A ticker does not have a personality. It has statistical distributions, it has liquidity profiles, historical beta, and order flow. When you say the AI will understand where TSLL often fails, you are taking stochastic price action, which is driven by random external macroeconomic events or an earnings report, and assigning a permanent behavioral narrative to it.
But patterns do exist.
The reason NVDA bounces at a certain level today has to do with its current fundamental valuation and option chain dynamics, not because it has a bouncing personality.
But personality isn't being used as some mystical term here. Let's elevate what that actually means in the market microstructure.
Please do.
Imagine knowing that every time SoFi dips below $7, the exact same 3 institutional algorithmic execution programs trigger a buy. That is not just a chart pattern. That is a behavioral footprint.
Okay.
Human psychology and institutional algorithms get trapped in specific assets. A purely statistical model often strips away that highly specific local context in favor of generalized rules.
Okay. Framing it as identifying sticky algorithmic footprints. I can actually see the value there. I will concede that institutional order flow leaves repetitive traces.
Exactly.
But my fundamental issue is how the Eastmont SDK is attempting to extract that footprint. Because if you want to find an algorithmic footprint, You analyze level 2 order book data. You look at tick-by-tick volume.
Right, quantitative data.
You don't do what this document proposes, which is the visual memory system.
The visual memory system is the core mechanism of how it builds this contextual memory, though.
And it is terrifyingly inefficient. I mean, if you're listening right now, you're probably screaming at your device the exact same thing I am.
Which is?
Why on earth would you use computer vision to read a screenshot of an RSI level when a raw data API gives you that exact number instantly and flawlessly?
Let's break down the actual pipeline before we dismiss it entirely, because it is an incredibly ambitious technical implementation. It operates in 6 phases.
6 very complex phases.
Phase 1 is a Dropbox watcher for screenshots. It literally just watches a folder. Phase 2 takes that screenshot and runs OCR, optical character recognition, and chart extraction.
Which introduces a massive point of failure immediately.
How so?
A slight resolution drop in the screenshot, a weird artifact on the screen, and suddenly your OCR thinks an RSI of 80 is an RSI of 30. Why bypass the API?
Because of what happens in Phase 3. Phase 3 focuses on Candlestick and support and resistance recognition. Yes, an API can hand you an RSI number faster and more accurately. I'm not debating that.
Good, because that's undeniable.
But an API feed provides isolated data points stripped of spatial and visual context. When you pull an API feed, you get the open, high, low, close. That's it.
That's all you need.
No. When the visual memory system ingests a screenshot, it is seeing the relationship between these elements simultaneously, exactly how a technical analyst does. It sees a specific doji candlestick formation, a sign of indecision, occurring precisely at the historical support line while the RSI diverges.
Okay, but
You are capturing the geometry of the chart.
But geometry is just math visualized. You can calculate a divergence or a support line programmatically without ever looking at a picture.
It's much harder to code every possible visual variation.
The entire workflow the text describes, screenshot, to OCR extraction, to behavioral analysis, to Obsidian journal generation, to SDK memory ingestion, to a NotebookLM reasoning layer. It is the definition of a Rube Goldberg machine.
I think that's unfair.
Every single step in that chain involves translation, and every translation involves data loss or misinterpretation.
It is only a Rube Goldberg machine if your end goal is simply triggering a buy order as fast as possible. But that is the old paradigm. The goal of Phase 4, the Obsidian journal auto-generation, is what completely changes the game.
The journaling aspect.
Yes, Obsidian is a note-taking application that operates on linked markdown files. Think about how normal market data is stored. It's a relational database. Rows and columns. Date, time, price, volume. It's just a spreadsheet.
The most efficient way to store data.
But Obsidian creates a graph database. It maps relationships between ideas. When the AI generates a journal entry about Mars volatility, it links that note to broader concepts like Bitcoin correlation or midday chop.
So it's building a wiki for itself.
It's building an interconnected web of behavioral knowledge. And that is exactly why the Phase 6 integration with NotebookLM is so crucial. NotebookLM doesn't just keyword search a spreadsheet. The NotebookLM reasoning layer traverses this linked knowledge graph.
Right, it reads the semantic connections.
It essentially reads the market's behavioral history, following the synopses of linked observations to answer complex queries. When you ask ticker behavior Mara, the reasoning layer pulls from hundreds of interconnected journal entries that combine visual memory, technicals, and historical context.
Look, I understand the mechanics of graph databases, and I understand how an LLM can traverse semantic connections. But you are assuming that NotebookLM is capable of producing rigorous financial analysis from these auto-generated journal entries.
I think the early tests show it can.
Let's look at the reality of testing this. When the DipFire X bot detects an intraday dip, it executes based on a predefined threshold. It is ruthless, and more importantly, it is testable.
Testable, sure.
You can run a Monte Carlo simulation. You can backtest a numerical parameter across a decade of tick data in seconds. How do you rigorously backtest an Obsidian journal auto-generation?
You don't backtest it the way you backtest a moving average. You validate it through its ability to accurately answer synthesis queries over time.
Which means you can't quantitatively trust it with capital. You are replacing the execution bot, which dispatches triggers with zero latency, with a system that wants to write a diary entry about the market and ponder its relationships.
It's not replacing execution.
In high-frequency or even swing trading environments, latency is everything. By the time your system has taken a screenshot, OCR'd the candlestick, generated a markdown file, linked it in a graph database, and had NotebookLM reason over the semantic connections to conclude that Mara has a volatile personality, the alpha is gone. The move has already happened. The market does not wait for your AI to finish journaling.
But again, you are conflating the execution layer with the intelligence layer. The goal outlined in the future SDK capabilities is not to slow down execution, but to elevate the quality of the alerts being generated. The orchestration layer runs in parallel.
In parallel?
Yes. When a user queries reload zone TSLL, they aren't asking for a millisecond execution trigger. If they wanted that, they just let the execution bot run. They're querying the SDK because they want deep, synthesized market intelligence to inform their overall strategy.
I see.
By transitioning into an AI market memory operating system, the SDK becomes capable of identifying macro regime shifts, a fundamental change in how the market is behaving, that a simple, fast DipFire X bot would blindly trade into and get stopped out of over and over again.
But does a macro regime shift really require an LLM interpreting text files? I fully support the swing bot, which is already present in the current bot ecosystem.
Right.
Why? Because it handles higher time frame swing analysis mathematically. I fundamentally question the necessity of these journal feedback loops.
You argue that the visual ingestion captures nuance that raw data misses. I would counter that what you are calling nuance is actually just noise.
How is spatial context noise?
Because financial markets are the noisiest environments on Earth. The entire history of algorithmic trading has been a quest to filter out noise to find the true mathematical signal.
Yes, but
By feeding screenshots into an AI so it can generate qualitative observations, you are intentionally re-injecting noise back into a pristine mathematical system. You are taking objective facts and smearing them with subjective interpretations. It sacrifices objective rigor for the illusion of deep understanding. It isn't an illusion, it's a higher order of understanding. And I think that's the core of our disagreement today. The final realization stated in the document is really profound. The Eastmont SDK is evolving from a ticker analyzer into a behavioral market memory system.
Right.
We have to recognize that the market itself is not a pristine, sterile mathematical environment. It is a chaotic ecosystem driven by human panic, algorithmic cascades, and historical precedent.
I agree with that.
A purely quantitative bot, no matter how rigorously backtested or how fast it executes, lacks the capacity for contextual memory. By building a unified AI architecture, one that utilizes visual chart memory, graph databases, and ticker personality profiling, the SDK transcends simple automation. It becomes a system capable of merging hard data with historical nuance.
And while I absolutely concede that the architecture of linking visual OCR extraction with a graph database like Obsidian is a brilliant piece of software engineering, I maintain that applying it to market execution fundamentally compromises the system.
I understand your hesitation.
The current bot ecosystem provides the exact objective rigor required to navigate market chaos. You don't manage chaos by adding subjective AI narratives to it. You manage it with strict, immutable mathematical parameters. The transition from precise execution triggers to an AI generating journal entries may sound like a massive leap forward in reasoning, but in practice, it risks replacing the cold, reliable truth of probability with the subjective ambiguities of a machine learning hallucination.
While it is clear we are looking at a profound philosophical split in how to interact with market data, the integration of the NotebookLM reasoning layer over an automated Obsidian knowledge graph presents a radically different approach to market intelligence.
Very different.
It leaves us, and certainly everyone listening, to consider whether the future of these systems lies in doubling down on raw mathematical execution speed or in cultivating deep contextual behavioral memory.
Absolutely.
Just like trying to decide whether a trader's greatest asset is their reaction time or their experience, we are left wondering which will ultimately prevail. There is clearly much more to explore as this transition unfolds.